A lot of great info for you. We're going to be talking about another CMBS default, why it is so important. It's a big one too, 161. It's going to be huge. Let's talk about that in a second. I also have a story from Fortune. Things are getting weird, really weird in the housing market. To say that things are getting weird is an understatement. So as we get going, thank you for everyone that hit the thumbs up button. And also, I want you to remember this is the Real Estate Ninja channel. This is a backup channel to the Economic Ninja, my brother. We're just sort of working together because you never know when one of us are going to get kicked off. All right. So if you haven't seen this channel, hit the subscribe button if you like real estate content, because there is so much stuff going on in the real estate market as it's collapsing. All right, so this story first is out of Zero Hedge, and it is entitled Dominoes Falling? Brookfield defaults on 161 debt for DC office buildings. I guess they ran out of space. We'll find out if it's million or billion. Pretty sure it's million. With the recent stress in the regional banking sector, sentiment in US commercial real estate and especially the office sector has turned negative as investors prepare for potential spillover effects, with JP Morgan, JP Morgan, Morgan Stanley, and Goldman Sachs all joining the gloom parade, especially as high profile defaults continue to make headlines as borrowers face higher debt servicing costs and refinancing becomes much harder ahead of a $400 billion commercial real estate maturities this year alone. Now, when they're referring to that, they're talking about the loans out. And I'm sorry, it's hard not to say this stuff with a grin because this is something that I've been preparing for since 2010. Quite frankly, I saw this bubble forming again in 2014, 2015. It started to pop in 2019, and now we're just at the mother of all bubbles bursting right now in real estate. And I understand that the commercial real estate sector, as it implodes, is going to absolutely destroy the residential real estate sector. And I know there's going to be a lot of opportunities for all of us. So it just gets me excited. Sorry, I get pumped up. But these commercial real estate loans that are out there, the mortgages, are having to mature. They're maturing. They're going to either need to be paid fully off or they need to be refinanced. Well, these companies all around the country do not have the money to refinance at much higher rates. Okay, so there are going to be massive, massive defaults. And Brookfield, this story that we're going to talk about defaulting, has been in the news a lot, actually. Not this exact story. They've been defaulting. Really, they've been all over the news since last November, defaulting, because this crisis is getting much worse. All right. It says the latest headline fueling concerns about a potential commercial real estate crisis involves a Brookfield Corporation fund defaulting on a $161 million mortgage for 12 office buildings in Washington, D.C. Now, this is all brand new. This is not the Brookfield defaults that were going on in Los Angeles. According to Bloomberg, the loan was transferred to a special servicer. And just so you guys remember, special servicer means you're screwed, we need help. And when I say you're screwed, we're talking about the bank. With the borrower to execute a pre-negotiation agreement and to determine a path forward. Real estate data firm Green Street said DC office spaces values have slid 36% through March compared with a year ago due to rising vacancies among the rise of remote and hybrid work cost post-COVID. You know, there's a lot of people out there, financial gurus like Dave Ramsey, that say that real estate has never gone down. It's only actually went down for about a 5-month period way back in 2008. Completely wrong. That's totally false. But it's interesting because there are gurus that you're going to see, and they're going to be making headlines. They're going to get picked up by CNBC and Yahoo Finance because they're like know-it-alls, right? They know it all, but they don't. They just don't. They're going to start talking about how this commercial real estate is really about to affect it could affect residential. This could be the time. And it's just because they're watching channels like this and other channels that are out there beating the war drums going, hey, this is a big deal. This crisis is going to really severely hurt the banks every single time. Like we're talking about right now, $161 million, right? Defaulted on. The bank is going to try and get Brookfield to do anything they can to work out any kind of deal. Because right now, there are a lot of homes that are so underwater, banks literally, like, we're talking well over a year. There's over like 600,000 properties in America alone right now that they are so in default that the banks will pay you to take over the payments, right? That's how bad it is. Well, it's going to get a lot worse. So as these companies like Brookfield, they're getting like courted by the banks, please just pay anything, just figure something out. We got to figure something out. What people don't realize and what some banks don't realize is how bad it is for Brookfield and other commercial real estate companies. All right. It's really, really bad. Even if they could make this one right, they're not going to be able to make the next 20 right. All right. Real estate, the gold standard measure of office occupancy trends is still the card swipe data provided by Castle Systems. The average office occupancy across Washington, D.C. is only 43%, and that has yet to recover from pre-pandemic levels. And I'm going to be honest with you, and please let me know down in the comment section if you believe that you're going to see in any time soon. I'm talking about like the next 5 years. If you are going to see office occupancy actually go up anywhere near pre-pandemic levels? I think the answer is no. Brookfield has also defaulted on debt tied to 2 Los Angeles buildings, the gas company tower and the 777 tower. I guess the number 7 isn't very lucky anymore, 777. A spokesperson from the company blamed the pandemic for its CRE challenges. Of course they're going to do that. So again, like I said, the bank is now trying to get Brookfield to do anything they can on the Washington, D.C. properties, but the other banks couldn't get them to do anything on the Los Angeles properties. All right. Brookfield could potentially be the first in a series of companies defaulting on their office space loans. Well, that's pretty absolutely insane because that's already happened. So think about this. The author of this news story is saying, I mean, you want to talk about Captain Obvious. Brookfield could potentially be the first one in its space that is defaulting. No, you're the actual reporter. They are defaulting. They have defaulted. They have missed multiple payments. That's called default. But hey, this is why you get paid the big bucks, right? Write these stories. It says right here, we've pointed out that the state of the CRE market is in dire shape as delinquency rates across property types, particularly offices, are rising. The lending environment is getting tougher ahead of a $400 billion commercial real estate debt maturity this year. $400 billion. $400 billion is going to mature this year. That nobody has the money to refinance that $400 billion at higher rates. Can you imagine? Those rates were probably came around 4 or 5 years ago, 5 years ago, 6 years ago. So you're sitting at literally like a lot of, I can't even guess or speculate on what those commercial rates were because commercial rates are higher than residential rates. But I'm telling you right now, they were much, much lower. So meanwhile, the collapsed Silicon Valley Bank and other regional banks has put a magnifying glass on regional banks, and their CRE loan books remain a significant concern. Now, you've seen this with Silicon Valley Bank, especially its CRE loans. Banks that were coming in and bailing out sections of it, like buying up some of their assets, did not even want to touch the commercial aspect, the real estate assets right there. And I'm telling you right now, you're going to see the Federal Reserve have to take a lot of these on their books. And then eventually they're going to convince the government. And the scary and sad thing is this current regime will take that. And it will be at the cost of our children and our grandchildren. It's going to be horrible. This will cause an acute credit crunch in the secondary CRE markets. And then there's Bank of America's Michael Hartnett, who recently said, what commercial real estate is. It's a boa constrictor of tightly wrapped around the economy, suffocating growth for the next 2 years. Well, just so you know, Michael, it's not going to be the next 2 years. You're literally probably looking at least 5 years, okay? Bloomberg pointed out about a dozen buildings in the Brookfield portfolio. Occupancy rates averaged 52% in 2022, which is down 79% in 2018 when the debt was underwritten. So again, we're right there. It's showing you that we're about 5 years. We're at 5 years maturity, and that's when we're going to have to see these commercial real estate loans re-amortized, refinanced at much higher rates. Remember, in 2018, when the occupancy rate was at 79%, that's what Brookfield was basing their cash flow models and how much debt they could take out against these properties back then. So to say that they've fallen significantly since 2018 is an understatement. The onset of the commercial real estate crisis in the office sector will likely spark significant issues for regional banks and the Fed. Yes, and I'm telling you right now, you're going to see it in earnest by the fall. All right, now let's dive into the next set of news, guys. To the 150 and ladies, 159 people that hit the thumbs up. Thank you so much. From the seriously, it means a lot to me. All right, this is out of Fortune magazine. It's entitled, "Things are getting really weird in the housing market. It's just when you thought real estate only went one direction, like Dave Ramsey says, you were wrong." That is really what's happening here. So here we go. The 2023 housing market doesn't look like a national housing crash. It also doesn't look normal. I love how they put fun spins on it. This is what they did in 2006. Something, it's 2006, houses have been going up for like 4 years solid. Interest rates have been going down. Now they went up, the interest rates, and something just doesn't feel right. Yeah, I'm sure it's nothing. That's exactly what people said. You want to know why? Do you want to know why? It's because the ninja had to deal with it firsthand. When he was racing around saying the sky is falling, literally, real estate is going to crash, sell all your real estate, all the people that had like one rental, like, you know nothing of the sort. My mortgage person and my real estate professionals say that I am totally safe. And I'm like, you're not safe. They're idiots. Sell. And they're like, you are a moron, sir. And you know what's funny? All those people later in 2008, all I saw was, "So how's it working out for you?" "Do I know you?" "Sorry, I'm busy moving. I had to sell my house. I lost it." It was really awkward, but yay, but this is what's going on. This is out of Fortune, okay? Hey, 2023 housing market doesn't look like a national housing crash, but it also doesn't look normal. That's what they say in the beginning phase. And we're in the beginning phase of an epic collapse in real estate. So this is why I want to show you and lead you by the hand. And like, we're going to crush it. This is when you're going to make money. All right. Most housing analysts expected 2023 to be a rough year for the housing market. That is lie. That is a straight up lie. Just so you guys know, in 2022, the beginning of 2022, all these housing analysts from Zillow, Redfin, all the companies that like really actually stand to lose something if you stop buying and selling real estate, they were all telling you the absolute opposite. The green sky, the blue sky is blue, the grass is green, get out and buy and sell a home, because they said, we're out of the pandemic. Do you remember that? Do any of you remember the analysts coming out and saying how great 2023 is going to be because we are now finally out of this worldwide pandemic and let's get back to business? Well, it was not business as usual. So that is a straight up lie, Fortune magazine. In fact, among the 29 major housing forecast models, 24 forecasted a national home price decline for 2023. Again, those numbers came out at the end of 2022. These are people that are late to the party. But so far, that hasn't exactly come to fruition. That's true. That's not. Velocity collapsed. Though the first few months of 2023, the U.S. housing market continues to show signs of stabilization. That's great. That means there is no problem. I don't even know why I'm on a live stream right now. Existing and new home sales have inched up a bit this year, and home builder confidence has improved. So let me explain why this has happened. We get the right words. Existing home sales have inched up a bit. Well, states like California have programs to give you literally your first 20% down payment for free, 0% no deferred payments. You don't have to pay. The federal government is now going to fine people with high credit scores and big down payments, higher mortgage costs, upfront mortgage costs, and the people that have low credit scores of 620 or less are going to be allowed to have less fees because it should be fair. Okay, so you're just pushing more people that don't know what they're doing into real estate into the market. Home builders are out there literally cutting prices 10%, like Toll Brothers, Lennar. I knew Lennar was. And you see massive percentage decreases in prices as sellers, literally private sellers, are dropping their prices. Okay. So all of those things combined would make sense that a small group of what I call the dumb money, and I only say that because they have no concept of what's happening in this real estate cycle, move in and pick up the little bit of inventory that's out there. Okay, copy. Just want to give a little bit of clarity to what's going on. It says firms like Zillow, CoreLogic, and Black Knight have all reported positive month-over-month home prices increasing in the spring. So just so you guys know, that is normal every single year, whether we are in a down market or an up market in real estate. It's called seasonality adjustments. It's because this is the time when people, and again, the dumb money moving around, just got a little bit of money from a tax return and they were told by a real estate agent, this is the time to buy, you're not going to be able to buy. They move in. It's also a great time to buy a car. This is like literally car dealer Christmas. Okay. So it's like Captain Obvious has just taken over the news and said, month over month, this is great because we went from the winter into spring. What's going on for starters? Housing affordability has improved this spring as the average 30-year fixed mortgage rate, which topped out at 7.37 in November, came back down to around 6.5%. Do you really think that there's a big difference right now between 7.3% and 6.5 when you're looking at the grand scheme of things of how much people have per month to spend towards a mortgage? I mean, honestly, I know the payment's a lot more, right? But on a percentage basis, it really isn't that big of a deal. It's not like you literally went from 3% to 3.6% in a mortgage. That on a percentage basis, that really brings your payment up, right? But with the price of homes at the levels that they are, to see that little bit of a drop from 7.3 to 6.5, do you really think it makes a big difference when consumers are literally having to pay double the price for eggs this year as opposed to last, or gasoline prices, or their natural gas prices? Think about that. It's not going to affect it. But again, this is the media trying to put a positive spin on this to get you out moving because the market's imploding. It says additionally, a lack of homes for sale coupled with the market entering its busier spring period. Oh, there you go. Now they tell you the truth. Has at least for now published the national housing market back into equilibrium. That said, under the hood, the housing market isn't exactly normal just yet. Some housing markets are booming right now, including Scranton. You guys want to move to Scranton? Put down in the comment section what you think about that. But it's booming. While other places, including San Jose, are still passing through a home price correction. No, it's plummeting. Like San Francisco has literally lost over 30% in home prices since June. That's plummeting. And even within a particular market, it could vary a lot. To better understand just how weird and divided the housing market is right now, Fortune built 7 interactive charts to display zip code data level. Well, that's great, but I don't care. See, the point being is, yes, you can pick out a single little area and go, look, it's booming because of some industry picked up or some tax breaks were given because of certain abilities for, I'm totally blanking out on the term. Holy cow. When you invest in places that they give you tax benefits because it's literally a slum and they want you to invest and fix up the properties. Why am I forgetting this? I'm a horrible real estate agent. Point being is this is live and you can see those little like upticks, but it doesn't matter because the banking industry is collapsing, which means it's going to be harder and harder to get a mortgage. Now, unless you have bad credit and they want to talk a bunch of people at the last minute to buy mortgages that they technically can't afford, and they're going to prove it in about 90 days when they make their third payment. They go, what the heck am I doing? What did I sign myself up for? It's literally like, you go in to buy a house at $500,000, you go into the sales office and say, hey, it comes with this carpet, or you could have this carpet. And it's not that much more. And you start adding up the cost. And then once you go to sign for the mortgage, you go, whoa, wait a minute. How did my payment go from $3,200 to $3,600? Now that's okay. It's just an extra $400 until you make 3 payments. And you're like, wait a minute, we really don't have this in our budget. Point being is that things are happening. They're happening fast. But the sad thing is for people that are out there buying homes right now that are literally buying in fear because they can't afford, if they don't buy right now, they're not going to be able to afford in the future, that high pressure sales that a lot of real estate agents are out there doing. And not all real estate agents. There's some great real estate agents that would rather have a customer for life rather than just get them in and out. But there's a lot of people that are fly-by-night real estate agents that just became a real estate agent in the last 2 years because, hey, real estate agents are making a bunch of money. I should jump on that bandwagon. We saw the exact same thing happen in 2005, only see those agents literally leave in the middle of the night and become delivery drivers. Literally, it's a true story. Point being is that there are a lot of high pressure sales out there talking people into things they can't afford, especially going back to the beginning of this video, as the commercial mortgage industry is imploding, is going to severely cause banks to withhold money that they put out on regular mortgages. You see, layoffs are massive and they're going to get worse. And as you see more and more layoffs hitting our country, that's going to be more and more homes hitting the market because they don't have any income anymore. That's what you have to watch. That's the biggest identifier of the health of a real estate market is how many people are getting laid off. David's Bridal just announced another 9,000 layoffs. They're going through their second bankruptcy in 5 years. And you're going to see more and more and more of those companies. It's not just McDonald's, Amazon, Google, Facebook, all these companies laying off people. You're going to see everyday companies that aren't those massive monoliths that are laying off 5,000, 8,000, 15,000 employees in one whack because they have no business. Guys, this is a big deal. To the 360 people that hit the thumbs up during this live stream, thank you so much for helping me get the news out. This is going to be a great time to be an investor. This is going to be a great time to make the most of this opportunity, but you'll only be able to make the most of it if you're ready. Get your debt paid off, get that credit score ready to rock and roll, and have some dry powder, meaning some money off to the side, cash and seasoned cash in your bank accounts. And have multiple bank accounts because we're going through a banking crisis. All right, with that being said, I thank you so much for watching the Economic. I'm not that. I'm the Real Estate Ninja. This is the Real Estate Ninja channel. If you don't know it even existed, hit the subscribe button. All right, guys, that being said, Real Estate Ninja is out.